Good afternoon, 8 hours, 3 p.m. Saturday. The weather is so good, I should not be in the studio doing my webinars. We should all get out on the farm and breathing the fresh air for this webinar. Today's topic, tax planning for year 2025. Small business owners need this for a good reason or for good reasons. There's a lot of reasons for this webinar to happen today. So let me walk you through this, okay? This is our website, communitycpa.com. I want every one of you to get to know our website. If you have anything in your mind you want to ask, understand, you can literally come to our website, make an appointment with us, or on board with us on your own, become our client. We will never tell you that we don't take new clients. I know a lot of CPA firms nowadays doing that because they are overwhelmed. No, we are here to help our small business owners, and this is how we live our life. So there's no such a thing about we got too many small business owners. No, the more the better, and we want you to become our clients. This is our website. And our firm, in one slide here, we talk about all these numbers, right? We have more than 12,000 clients. We have 48 professional staff in our firm, and 29 years in service. Okay, if I add every one of our experience up, like how many years we worked in tax accounting field, our total accumulated experience years are 129 years. So yes, it's a lot of time for a lot of people, and we speak 12 different languages, and we have 6 different branches. We, as a firm, we only have one goal, is to serve our small, medium-sized businesses. You know, it's easy said than done. Say, well, grand goal, you just want to help small businesses. In our practice, we had so much success in the practice, and we literally can, if we are allowed to, we can actually give you the people who are coming out of our hand, become a big company, and they, sad to say they're no longer with us. They're with KPMG, but, what we are saying here is that we help you to grow. So that is really what we do every day, all the time. This is our YouTube channel. You can find all of our videos in YouTube channel. We accumulate them, every time we finish a webinar, we put that in the YouTube so you can search and you can find us. And in this webinar, I refer to some of the YouTube webinars to give you that thumbnail so you can see what it looked like, and you can find them here if you want to listen more, right? So I had 2 books published. I have 2 more to go. Not done, so I cannot be dead. I need to live because I need to finish the other 2 books. So with that said, I have motivations to live a better life and to continue contribute to the society, and every small business owners have that. I knew it. We have motivation, so nothing can knock us off, nothing can beat us down, and you're just gonna go. It doesn't matter how the environment is for you, me, and others, and we are focused on what we can do to do better on our business and on our personal life, right? No responsibility disclaimer, and we do that every webinar. So just to say that you take responsibility of what you learn out there, okay? All right. What are small business owners doing these days? I know you're gonna ask me because as a small business owner, you run your business, right? You're in the very lonely world. You don't normally have someone who runs exactly the same business with you, like you, and they communicate with you. So people are kind of running things on their own. But community CPA is different, right? We have so many businesses that we're dealing with. We can see restaurant A running this way. We can see restaurant Z is running the other way. So we actually have a collective experience. So let me tell you what are the other small business owners are doing. So this is literally the services that we provided here, and that we see how people are picking and choose services. So I'll tell you what is hot, what is not hot, right? So the hot service, I listed about 6 of them, 7 of them, no 6. Okay, the first one is trust establishment by small business owners. A lot of small business owners, a lot more than before, wanting to set up living trust, and wanting to set up a deportation trust, want to set up irrevocable trust. It's all trust, right? So trust instrument has one commonality, which is a private documentation, and you can't really find them on the state website or on the federal data acquisition, so you don't find them easily elsewhere. It is a private document. It has different functions in here, so people, there's a lot more small business owners are doing trust work because they want to arrange the future. They want to control the future as much as they can. So sponsorship-based immigration, we see the tendency going up in there as well. Of course, the ICE is deporting, is doing immigration raid, but there's also immigrants from other countries are going through proper channels, apply to become to come to U.S. So it's more like a sponsorship based means that they actually would have business relationship to U.S. and how they apply for their visa to come in. For example, L1, right? So we have seen the uptick of L1 application coming in. And the formation of nonprofit organization is also on the rise. I think partially is because when the government is dropping certain things, they're no longer doing that. They don't give funding on certain things. There will be communities come together, forming nonprofit organizations, trying to help, trying to replace the function that was there before, now got dropped off by the government. So, you see the nonprofit organization is taking up. And the payroll compliance review is another thing that is pretty hot because the ICE raid, right? The ICE coming in to the small business and, take away the people that has status issues. So, some surprised by what's going on. The business owners are wanting to have payroll compliance review to make sure that if ICE come back again, or if ICE ever raided my company, and am I in compliance? Am I doing it right? So those are the things coming in right now. And tax review and tax planning is another one. People are more sensitive to what they are submitting to the government, wanting to have it done right. We literally have pretty sizable business. They have never really followed accurate methodology for their financial statement. Things were estimated, taxes was done with approximation, but now with the situation going on and the business owner felt like they need to have a better handle on their taxes. Taxes need to be reviewed, mistakes need to be corrected, and tax planning for 2025 so things can go on normal. So we have a lot of these good initiatives are coming from small business owners. Business ownership transition. That is also pretty hot because some of the transition is triggered by deportations, some of the transition triggered by age, some of the transition triggered by separation of the business partnership. So there's a lot of reasons for people to do ownership transition. Particularly the baby boomers group are transitioning the business to their children. So those are the things becoming very apparent. It is something that people are doing. So these are the things the small business owners are doing. Got it? So you can look at the list, goes, okay, so I'm also wanting to do this and that. So that's where you come in just normal. People are doing that, just like how you see the list. So, but today, my focus is on 2025 tax planning. We have said many things, right? The trust and the payroll compliance, all of these things that people want. But I am going to focus on tax planning today. So I will be focusing on what you can do with your business. So I am not talking about how you're gonna fix the tariff tax situation, how you're gonna stop the war among countries, and those are just not something we expected our small business owners to even trying to tackle. But what you can do is to focus on what you can do within your control, right? Utilize the OBBBA tax benefit. On July 4th, OBBBA become the law, right? And of course, the tax law and by large is benefiting larger business, but that doesn't mean it doesn't benefit small business. It is benefiting small business in the smaller way, benefiting large business in a large way. So, but still, you should utilize all the applicable OBBBA tax benefit. Reduce your tax liability for year 2025, have more cash on hand for emergency. Just good reasons, good reasons. Get input from professionals about your business operation is also something you will get when you do the planning with us. Or, I don't know how other firms doing tax planning, but at Community CPA, when we do tax planning, we're literally offering the direction that we think your business should go to. And prepare for personal future like estate planning. While we work on your tax planning for 2025, we absolutely touch on your personal side of estate planning. If we see the needs, we're gonna tell you, you should do this, you should do that. Of course, we are here to think for you. You are the small business owners. Sometimes the knowledge you get, is not readily available to you because they normally are used for the bigger business and the bigger owners. But you're small and we're small, so we learn. We never stop learning, and we try to give you everything we know and to help you grow your business so you can become bigger. Even some of my clients, after they become pretty large and they went to KPMG, but I still were able to talk to them about what KPMG does for you and how they are doing. That's also my ways of learning. It just, learning can never be end. We are here learning everything for you. So if there's any tricks for small business owners, we got it. All right. So the OBBBA related tax benefit, this is more of the quick zoom on this new tax act and for small businesses. I know there's a lot more things, right? There are things in there. There's Medicaid. There's other stuff going on, but taxes is one portion of it. It's about 875 pages for that portion of the taxes, and then you also have the portion of the taxes really don't have a lot of things to do with a small business because we don't really have that kind of situation. But here, these are the ones you should know. If you purchase a large item in 2025, large item means you paid a lot of money for it. Those are the places you need to look into a deduction. And OBBBA provided some really awesome deductions for those large purchases. R&D tax credit. So R&D and who qualifies R&D? Small business also qualify for R&D. It is not determined by your size of the operation. It's determined by the nature of your operation. So then tips and overtime benefit, and that is not taxable for the recipients, your employees. So those are impacting the small business owner because it's really now your employee may want you to put their tips on their W-2 because they know that they can get it tax-free. But they also know it's better to show themselves having more income, right, for reasons. So interest expense deduction also got expanded, so it got easier. So those are the OBBBA related benefits that I just want to impress you with it. But here are two YouTube's webinars we produced for you related to that. One is OBBBA 2025 provision for business to know. So in that video, we only carved out everything that is applicable for 2025. So it's a very useful webinar topic, and you can search for that. Now you know what a thumbnail looks like, and you can look for it, right? Then the other one is OBBBA to-do list for 2025. So, those are the videos that we already have in there, and just please go take a look. If that is something you say, oh, I don't know what that is, now you should know, okay? Tax planning is optimizing the tax structure. So now I also want to say that doing tax planning is not just about getting the OBBBA coming into work for you. Of course, that's a good reason because they just come out in 2025. So 2025 year's tax planning would be really important for you. So that is one of the reasons. But the other reason is also for the other things. That the second reason I want to mention to you is this optimizing the tax structure. Tax structure is something that you can change. Just almost like if you are a C corporation, you could elect yourself to be an S corporation, right? You probably know that path, but there is different path you can go to make the structure different. So OBBBA made C corporation tax rate a flat rate of 21%. So that altered the benefit of C corp versus pass-through entity. The reason I say that is, so if you have a privately controlled C corporation, your rate is flat, 21%. But in our personal tax return, if you pass through your profit into your 1040, and you could go up to nearly 40% on your personal tax return. So with that, there's a big difference, right? With the income tax amount, whether you pay income tax under a C corp or whether you pay income tax under your 1040, that can be a business owner's choice. Of course, someone will give you a talk about double taxation, but in this situation, with the rate being labeled at a 21% forever flat rate, is almost take away the benefit, take away the talk about double taxation. So doesn't really matter anymore. And the fact is that C corp is paying the least tax return. If it is privately owned C corp, you don't have any worry. It is your corporation, and you don't need to provide dividends to the shareholders. You are the shareholders, right? So it is not the same as the publicly traded C corp. You are privately held C corp. As a small business owner, you have the benefit to decide when you want to distribute dividend, so you don't worry about the dividend tax at all for when you are doing the tax planning. And a partnership and an S corporation, those are flow-through kind of entity. Flow-through just means that whatever you made in the partnership and an S corporation, it land on your 1040 for you. So it is not really taxed there, but it's taxed here. It has so much to do with your income tax bracket. If you already made a lot of money elsewhere, you got your K1 coming, slap it on you again, then you're just gonna pay a lot of taxes, folks. And if you are in the state paying 10% taxes, you might as well just pay 50% taxes. Those are the webinars you see on there, and I give you the thumbnail so you understand how you can find other related topics to the tax structure. So one of the video is called the Golden Triangle Real Estate Tax Structure. That is a particular tax structure that is most beneficial for real estate professionals. So you can take a look at that, see what kind of a golden triangle tax structure that I am talking about. So apply that in your life, and it will save you money. All right. So this next slide is actually a map that a lot of folks find that to be really helpful to them. Every square you see on this map represents an entity. So that 1040 has a Schedule C and a single member LLC square in there. So what we are trying to say is those entities are changeable. They can be elected to be a different structure as your need goes. So make sure that you get hold of the concept of can be elected the C corporation can be elected to S corporation. S corporation can be reverted back to C corporation. LLC can elect to be C corporation and it can be elected to be S. So it is so much change you can have it happen to benefit only one thing, your bottom line. If whichever way that make you pay the least taxes, that's the way you're gonna go, right? So if you look at the dotted line underneath, there are two type of structure. One is C Corp, the other one is nonprofit. I also have these lines going up and down, and you can see what kind of income that would be sending over to the 1040. Like if you form your own nonprofit organization helping the homeless people in town, then you actually, the only money you can take out of the nonprofit would be the W-2 paying for your time, right? Or maybe reimbursement on your travel expenses and whatsoever. But that nonprofit, after you form, you can donate money to the nonprofit. I mean, Community CPA, we donate money to nonprofit. We donate particularly heavy to Immigrant Entrepreneur Summit. So that is a nonprofit organization. We have been donating money people for over 18 years. So it's not yesterday's new doing. It is our life habit. It's our life habit from 2008. So with that said, you can actually donate to the nonprofit you established, so you save taxes on your personal side and you enhance what you want to accomplish in your nonprofit vision. With that said, let's look at what else the tax structure, the tax planning really touches on. Tax planning is optimizing tax structure, right? We talked about that. But tax planning is also mastering 3D concept. So what is a 3D concept? Three-dimensional concept. So you can see on that square box, you see tax structure on the bottom, so we already covered that, right? So right now, I'm going to spend a little time to cover the fiscal year and accounting method. This is what we call the 3D concept. If you do a tax planning and you don't touch on 3D concept, you're only touching the surface. You're not doing a thorough job. So let's make sure you understand that so you can do it. You can even do it on your own, okay? Our small business owners are very smart. I always come across super smart people. And, when I get those concepts really impressed on your brain, and you will know how to do it. There's no way you will be saying like, oh, I don't know what you're talking about. No, you know what I'm talking about. And I just need to give you the concept so you can run with it. Okay? Confirm fiscal year alignment. This is important. So basically what I'm saying is that in business, you don't have to run your business from January to December. Then report taxes after December, right? So of course, majority of the business is that way, but you don't have to. If you are running a seasonal business, for example, you're selling Christmas trees, okay? So what is the your income is coming from what month? Probably November, December. Am I right? Majority of the income is coming from there. So when you got your income, if you don't give enough time, you will pay taxes on bigger amount because you just sold your trees. You haven't even paid your bill yet because it's 30-day net. And then you already paying taxes because December 31st cut off and you got a bunch of income and you pay a lot of taxes. But in reality, you didn't even have that money because you have to pay the vendor. That is due in January, right? So those are what we call the seasonal businesses. Seasonal business need to be on the fiscal year. So that way you give yourself the longest time to spend the money. So the way to know whether you should be in the fiscal year or not is to look at your monthly income to find 2 months that has so much income in the year. Like in the Christmas tree example I give you, that would be November, December. So this family sell Christmas tree. November, December takes 50% of their annual sales. they are qualified to be in fiscal year accounting. So what their year should be? Their year should start November 1st. Their year should end on October 31st. Make sense? So they will be like making a lot of money in the first 2 months, then spend them all gone in October, then they pay what? No taxes? Smaller taxes, right? For sure. So that is what I'm trying to say to you. Once you have filed, let's say you say that, Ying, I already filed my tax return. It was calendar year. So now after hearing you, I should change. What am I going to do? And the two, you need, because you already filed from January to December calendar year, so you need to get IRS permission for you to change your year. So that is the form 1128. Application to adopt, change, and retain a tax year. So I have 2 videos here to give you an understanding of 3-dimensional of tax planning and also how to change your business tax year. Right? So that is the 3-dimensional concept, and we touched on tax structure. Now we touched on fiscal year. So let's take a look at accounting method. Accounting method. There's some changes in OBBBA this time related to accounting method, and I'll touch that on for the next slides. But this one just to tell you that the accounting method makes big difference in some business. Okay, and you want to know that whether you should be accrual business or you should be cash business. If it is accrual business and you accrue expense, you accrue income. If it is cash method business and you only recognize when the money is spent, only recognize when the money is received. So those are kind of, in the layman term, this is regular definitions for that. So, but a lot of times there's also rules about, accounting method. You cannot be cash. You cannot be cash method if you are a big business. So this is where the OBBBA, the new tax act, had made some changes for us. So cash method, OBBBA, and OBBBA expands the eligibility threshold for using cash method. So now it is available to business up to 35 million in average annual gross receipts. It is up from 27 million. It used to be 27 million. So, you take the last 3 years, you divide it by 3, and which number you have. If you have 35 million and less, and you can use cash method. But if you have it more, in this OBBBA, it says that you need to use accrual, right? So the accrual method accounting OBBBA also give some easy, basically they are getting simplified in terms of regulations. So they, in accrual basis, how you purchase inventories that need to be treated as inventory beginning balance, plus purchase minus usage and ending balance. Those are the things the accountant or your small business owners that you need to do, right? But under the simplified inventory rules from OBBBA, business using accrual method can treat inventory as a non-incidental materials and supplies, which means that you don't have to track that in your inventory anymore. You can just expense it out. They are non-incidental materials and supplies. So those are the things you want to know. The rules are being loosened up, and you could be in cash method as long as you didn't go over 35 million, and you have to be even if you are in the accrual method, your inventory can go easy. Things can be written off in the expense if it is non-incidental, right? So with that said, and you understand that the accounting method really determines how much of taxes you would calculate on that profit. For example, let's say if you're operating a school, let's say you are teaching painting of school, and you have your student register, and in the middle of the year, July 1st, and the 4 classes starts in I don't know, September. Then you have student register in December, class starts in March next year. So these fees that you received in December, that is not your income, isn't it? It is actually your liability. Because if you don't provide the classes in March, then you owe that money back to your customer because they paid you ahead of time and you did not perform. So, but normally in the cash accounting method, you would include the December into your income because you received it. But in the accrual accounting method, that is accrued. That is not earned revenue. So you put that under liability. So it is not your income. So that's where those are things are different. So with that, you really have to understand the method of accounting and see how that impacts your bottom line. You can have your accountant run those scenarios for you, right? In QuickBooks especially, switching between those methods are pretty easy. But of course, it's not like you can just switch without doing anything. If you are switching this, you have to file a form 3115 with IRS. You have to get that approval for you switching accounting method. Okay, same thing as the fiscal year. All right, now I'm ready to give you an example. So we talked about three-dimensional taxes you have to know, and before we did that, we talked about OBBBA. So really, 2025 has so much good reasons for you to do tax planning. OBBBA is a thing, and your three-dimensional tax concept is a thing, and you want to think about your structure, you want to think about your fiscal year or not, and the accounting method, how that impacting me. So all of these things are jammed in your mind, but it's all useful for our small business owners so you can be smart at paying money to the government. You know, I want you to pay taxes to IRS, paying it in such a big smile because you know you have to pay it, you know you are making contribution, and you know you are paying the right amount. That is important. Example, Jim and Molly. Jim and Molly, a couple, and they are running real estate business. They are running all kind of real estate business. They rent, they repair, and they also sell. They have license, real estate license. They also are doing flipping. You know, they're just the household of real estate dealings, right? So they file joint return. Let me show you what they have here. So we're looking at tax map. This is very similar to the tax map we have in our firm, and we do taxes this way. We don't just talk to you. We give you a visual. So some of our tax folks, some of our clients, they don't even want copies of our taxes. They just want this map. So they come in with a whole bunch of documents. We finish the taxes and we got it all done. They go home with one piece of paper, 8 by 11. And this is the tax map. So look at Jim and Molly. So they have this company. It's on the left-hand side. It's an LLC. They have their personal tax return. So this is before we did planning. This is before tax planning. So that LLC does everything. And it sells houses, it also repairs, it's also dealing with the tenant, it's also doing flipping, do everything. So we got $240,000 net profit, right? So this K1 goes into the couple's tax return, and you saw the red number right there. So this estimate, the profit of 240, that equals to regular income tax of 24,398. So that is 24% of income tax rate we're using. Then self-employment tax. Of course, self-employment tax. So that is $34,018. Together, that is your total tax for federal tax, $58,416. Okay, there's also state taxes in here, so it's about $66,000 in total if we add it together. I want you to remember this number. So this is normally what's going to happen without tax planning. That's what you're asking for. Okay, so you're paying taxes, you're paying self-employment taxes, and you're paying state taxes. Your total tax bill is $58,000 federal and another $8,000 on the state, so total about $66,000. All right, now this is the calculation, right? I was just telling you, and you can see there's 58,416 for federal, and then plus the other 8,000 some on the state, so 66,000. So now we do planning. We're gonna do planning for Jim and Molly. So you'll say, oh yes, yes, Ying, and tell me, what do you do? So step number 1, we set up a C corporation. We just call it a BBB Inc., not OPBBA Inc. That would be fun, right, to have an OPBBA Inc. So C Corp, whatever you call it. And we made it fiscal year November. The reason we want to make it fiscal year November is C Corporation, when you set it up, you can decide on your fiscal year. There's no approval needed. And so we start from November 1st, we end on October 31st. Okay? And then accrual basis, which means that we're going to accrue our expense, we're going to accrue our income. Okay? And then the BBBB Inc., they are providing repairs and flipping jobs for the LLC. Okay, so we are breaking the LLC up, right? We're breaking it up. We take the work outside of LLC, we're gonna put that in the C Corp. Step number 2, to form a S Corporation, CCC Inc. Serving service provider to the AAA LLC. I put in Inc., that should be LLC. So we're running payroll because, you know, Jim and Molly, they work there, so we need to run payroll for them. We even started 401k plan for them, and they can even do cash balance plan to put more money away, and they can also have insurance premium deduction on their W-2, and it's a management company, and they're dealing with renters. So our number 2. All right, so with this planning, the result is the AAA LLC has a profit of 4K, and the BBB has a profit of 58K. The CCC, that is the S Corp, has a profit of 28K. So we have W-2 payroll, we have deferrals. Now, let's look at our map. This is really interesting, all right? So on the left-hand side, and you have the 1120S, that's the new one we formed to handle the renters. Then you also have the original LLC, where only does the title holding for the property. So the profit on there is 4,000, and then the renter side of things, we got 28,000. Then the C Corp side, we have net profit of 58,000. Then on the 1040, as a result of that, 2 pass-through entity, C Corporation, it doesn't pass through, so we didn't have any arrows going between the 1040 and the 1120S, right? So you can see that the dollars come in. The 4,287, add 28,022, that gives us the 32,309. That is our K1 income. Okay. Now I have the W-2 coming in, and then we also have this AGI added up. It is 112,306. Okay. With that calculation going down, we have tax due 9,336. We have the state tax due 3,709. So that gives us about $12,000 on taxes. Of course, the C Corporation gonna pay taxes on its own, right? So we already see the tax they pay is $12,000 on the federal, $3,000 on the state. Now, let's take a look at how the math goes. So with this tax comparison, before, it is $66,000, $642, right? We knew that one. We saw the map, right? It's 2 boxes. You know, one goes to the other one, we got 66,000. Then after you have all of these tax calculated, total tax from 1040 to the C Corp we have 28,532. Okay, so what is the tax saving, folks? For this work, you saved 38,110. So you may like, okay, so what contribute to that? Couple of things. Number one, you got away from paying self-employment tax on 240,000 income from the LLC. You only paid self-employment tax or Social Security Medicare, and out of the $80,000 you have on the W-2. So you reduced self-employment tax. That's number one. Number two, you reduced the tax rate. So the C Corp tax rate is only 21%, but your personal tax rate, if we add your self-employment tax with your income tax, we're talking about 40%. So you reduced on the rate as well. So with that said, this is a collaborated result, right? So your total tax saving is $38,000. And I can guarantee you, you will not pay $38,000 to get your tax planning done. Maybe $3,800, that is already plenty. So really, it is not about the fees and all the troubles you go through. It is whether you realize how much of taxes you would have saved if you have the right plan on hand, right? So now, let me just go to give you the closing remarks from us to you related to 2025 tax planning. Year-end 2025 planning benefit is an important steps our small business owners need to acquire. It is not given to you without you doing anything. So for Jim and Molly, this plan reduces their tax liability by 42%. 42. That is from 66,000 went down to 28,000. With 38,000 extra cash on hand, Jim and Molly can deal with unstable economy. Don't you agree? Yes. Tax planning is not good to have for your business and the business, for your family and the business. It's actually must have. You must have it. When everything else costs more in price, tax saving are the places you can ease your losses. So it is not important. It is not something good to have. You must have it to plan, to really understand where the saving will come from, and use that saving to deal with the hard times that you are facing today. All right, desire to know more? Of course. I give you those thumbnails, and you can go to our YouTube channel and just search for those topics and study it on your own. Our YouTube channel is a do-it-yourself channel, and we want you to do it yourself. But if after you studied our channel, you still have questions, and you will come to here and book appointment with our partners, and we will take care of you. Of course, and one thing I want you to know, we are a firm open 6 days a week. Have you know any other CPA firm open 6 days a week? Of course not. We're the only one. We open 6 days a week all year round. We don't have tax season, but we do have tax planning season. If you don't do things right now before the end of December of 2025, there's some of the things we can do for you to reduce your taxes cannot be done. We have to be in the year right now to fix the year right now. So make sure you understand the timeline. Our number, 515-288-3188. You call, we answer. Guess what? We don't have dropped calls here. Every day, we measure the whole entire firm by asking, do we have dropped calls? Our system will tell us we don't have dropped calls. So I am that confident to tell you that if you call, we got the answer. I'll see you again on Tuesday. Bye-bye.